Hi, Assalamualaikum. My name is Nur Akila binti Amrin, and today my group going to present about group presentation of Advanced Taxations TAX667. We are from class AC2203C. So case 1A is about whether to choose setting up a branch or subsidiary in Malaysia. My answer: Red Tempanet Limited should choose to set up a subsidiary company in Malaysia because the subsidiary company is different legal entity from its parent firm, and it must register as a Malaysian company in order to be responsible for its own obligations and responsibilities. Meanwhile, branch firms are not different legal entities from their parent corporations, and the parent company is completely accountable for its Malaysian branch, obligations and liabilities. In terms of the independence, the subsidiary firm is not dependent on its foreign opponent, making it self-sufficient and allowing it to operate in Malaysia under its own name. Red Tempanet Limited wants to rename it as subsidiary new company, which is Newco in this instance. Meanwhile, the branch is dependent on its parent company because it is only an overseas extension of the parent company that runs and engages in the same commercial operations under the same name. Besides that, a subsidiary is an appropriate for international or local businesses that want to develop their activities in Malaysia for an extended length of the time. Branch businesses, on the other hand, are better suited to international corporations looking to extend their activities in Malaysia for a limited time. In addition, a subsidiary is classified as a Malaysian tax resident for tax reasons and is liable to local taxes as well as numerous tax benefits and deductions. A Malaysian branch office, on the other hand, is classified as a non-resident corporation. Non-resident corporations are not eligible for the tax benefits provided to new startups and resident businesses. With tax modifications, profit attributable to the branch are taxed at a rate of 25%. Payments paid to the branch for services rendered in Malaysia are subject to a 10% plus 3% withholding tax. So for the case 1B, whether to commence business during the financial ended 31st December 2019 or 2020, my answer would be Newco should choose to commence the business financial year ending 31st December 2020. According to the Short-Term Economic Recovery Plan, PENJANA, newly established SME can get up to 20,000 ringgit Malaysia tax rebate for the first 3 years. Hence, Newco should select to start their first financial year ending 31st December 2020. The SME is registered under Companies Act 2016, which is Sendirian Berhad only, and start their operation within the period 1st of July 2020 and 31st December of 2021 can get this rebate. To claim this rebate, the company can buy a new facility, plant and equipment, but cannot transfer from an existing or related company. The rebate is based on the actual amount of company operating expenses and capital expenditure. However, if the tax rebate didn't fully utilize it within any of the 3 years, the tax rebate cannot be carried forward to the next year. Thus, Newco should commence business during the financial year 31st December 2020 and Newco will be eligible to get rebates. Thank you.
For the case number 1, point C, the best tax incentive that can significantly reduce its tax liability after finish claiming investment tax allowance. State your reason. From my reason, tax incentive can be granted through income exemption or by way of allowances. Therefore, after 5 years claiming for investment tax allowance, Newco may apply for reinvestment allowance or RA, since the expansion project is qualified as qualifying project. Moreover, the additional qualifying capital expenditure incurred by Newco are also qualified as capital expenditure as it is used to carry out manufacturing activity for the purpose of qualifying project. Hence, by utilizing RA, tax liability of Newco will be reduced as a company will be given deduction allowance of 60% on the qualifying capital expenditure incurred, but it must be set off against 70% of the statutory income from the business is in respect of the qualifying project. In addition, if the RA exceeds the 70% of the total income, the unabsorbed RA can be carried forward to be set off against the future statutory income for a maximum period of 7 consecutive years upon expiry of the qualifying period of the RA. In such circumstances, the tax liability can be reduced as there will be amount credited to exempt income account, which is the 70% statutory income. However, if the RA together with any unabsorbed RA BF is below the 70% of statutory income, the amount of RA is credited to an exempt income account, which it is the amount of RA utilized. Hence, the company can declare exempt dividend to tier that can be distributed. Continue for previous slide. By applying AA, NewCo also can claim AA up to 100% of its statutory income in a particular year assessment if it could demonstrate that the level of efficiency ratio is more than industry average for the year as prescribed by Minister of Finance. By that, the tax liability can be reduced also. Therefore, best tax incentive that can significantly reduce tax liability is by claiming reinvestment allowances, which is entitled to be claimed for a period of 15 consecutive years of assessment. And for the case 2.A, my answer is generally PAMKA SDN-BHD should dispose of the old machines to the external parties on the last date of the next financial year end of 31 March 2021. The benefit of postponing the disposal is that PAMKA SDN-BHD can continue to claim a capital allowance for the year of assessment 2020, which will help to reduce the tax liability, if any. However, PAMKA generates adjusted loss, so it will simply increase the unabsorbed capital allowance to be brought forward to the future year of assessment, enabling the company to continue to enjoy tax savings in the future year. However, in this case, the accountant of the company made a view that some of the machines will have to be sold at a loss of which will be lower than the market value. In considering the balancing adjustment, which is the difference between the residual expenditure during the disposal of the machines and the disposal value, the disposal date shall depend on the arrival of the balancing charge or balancing allowance. If the disposal of the machines generates a balancing allowance in which the residual expenditure is greater than the sale proceeds, PAMKA should dispose of the machines at the financial year end 31 March 2020 to shelter the adjusted income of the company because the balancing allowance is a tax deductible. On the other hand, where the disposal of the machines generate a balancing charge, then PAMKA should postpone the disposal to the next financial year and 31 March 2021 in order to defer tax liability.
Assalamualaikum warahmatullahi wabarakatuh. I am Nur Zaira Safia binti Muhammad Khairul, and I will be answering questions relating to case 2, question B and C. We start with question B. Question B: advise PAMCA on how to save tax on the disposal of the stamping machine. Firstly, we will look at the period of ownership held by the company from the acquisition until the disposal date. If company decides to dispose in the current financial year, the total months will be 10 months, which is from 1st June 2019 until 31st March 2020. While if the company decides to dispose the asset in the next financial year, the total amount of ownership held by company will be amounting to 22 months. Pursuant to paragraph 71, Schedule 3 of the Income Tax Act 1967, the Director General of Inland Revenue may withdraw an allowance and impose a balancing charge to an asset which was owned by a person for a period of less than 2 years. In this case, if PAMCA Sdn Bhd decides to sell the stamping machine, whether in the current financial year or in the next financial period, the period of ownership on the asset will still be under 2 years from its acquisition. Therefore, paragraph 71, Schedule 3 can be applied, which makes the capital allowance obtained in the previous years is clawed back and will be treated as a balancing charge in the year of disposal. In order to avoid this, the company should use the benefit of control transfer to move the asset to another subsidiary, which is its most profitable subsidiary, Damchi Sdn Bhd. Next, we will move on to question C. Question C is: state whether Dalmo Group of Companies can make use of group relief to reduce tax liabilities in years of assessment 2020 and 2021. We start with Section 44A of the Income Tax Act 1967. It states that a company that qualifies for a group relief may surrender a maximum of 70% of its adjusted loss for a year of assessment to one or more of its related companies. In order for surrendering companies and claiming companies to be related, few criteria must be fulfilled. And some of the criteria are: number 1, both of the companies need to be incorporated and a resident in Malaysia. Number 2, both of the companies must have a paid-up capital of more than 2.5 million. Number 3, both of the companies must also have the same accounting period, which equals to 12 months. Therefore, for this case, year assessment 2020 and 2021, the loss incurred by PAMCA Sdn Bhd could not be transferred to Ruba Sdn Bhd or Damchi Sdn Bhd in order to help minimize the tax liability. Why? Because PAMCA Sdn Bhd, who is the surrendering company, does not meet the recognition criteria to claim for the group relief. And these are the reasons why. Number 1, PAMCA Sdn Bhd have a paid-up capital of 2.3 million, and the other two related companies, which is Ruba, is enjoying the investment tax allowance, while Damchi is enjoying the incentives of pioneer status. Therefore, because it does not meet the recognition criteria to claim for the group relief, thus Dalmo Group of Companies cannot make use of the group relief in order to reduce the tax liabilities in year of assessment of 2020 and 2021. Thank you.
Hi, Assalamualaikum. My name is Nurdini Eliani binti Nurul Ihsan. I am from AC2203C, and today I'll be presenting Case 2, Question D and E. The question would be: advise Ruba on the best method of financing its purchase of new machineries and state your reasons. Ruba Sdn Bhd is considering whether to purchase its new machineries by long-term loan or by leasing. My answer would be Ruba Sdn Bhd should purchase its new machinery by leasing. This is because by using leasing to finance the purchase of the new machineries, it will help Ruba in minimizing its tax liability by minimizing its profit for the year. Even though Ruba is not entitled to claim capital allowance on the leased machineries, as the company is not the owner of the machineries, the company is entitled to claim full leasing charge as a revenue. The claim of lease rental would be most advantageous as the full amount of lease rental is given revenue deduction in the year of incurred, while the claim of capital allowance needs to be spread to various years in accordance with specific rate. Other than that, the leasing charge would be increased the adjusted losses if Ruba is facing a current year business loss. The current year business loss would allow shelter of other income at the aggregate income level that incurred during the current year. And if the current year business loss cannot be utilized in that particular year of aggregate income level, the unabsorbed business losses can be carried forward to set off against any business income in the future years at the statutory income level expenses as it is incurred wholly and exclusively in the production of the company. Thank you. Question E would be, advise Damchi on which company should be taken over, TSG Sdn Bhd or KY Sdn Bhd, and the method of acquisition. State your reasons. My answer would be, Damchi Sdn Bhd should take over TSG Sdn Bhd and acquire it by purchasing their shares. This is due to the fact that Damchi Sdn Bhd would benefit greatly if the company acquired TSG Sdn Bhd. TSG Sdn Bhd also has a similar nature of business with Damchi Sdn Bhd. Since TSG Sdn Bhd is currently claiming its first year of pioneer status, which provides 70% exemptions from the company's statutory income for 5 years, they can continue to claim the status for the next 4 years of their assessment. It can also help Damchi Sdn Bhd save money on taxes. Next, I'll be passing the next reasons to my teammates, Nurin Akila.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurin Akila binti Nazim. I am from class AC2203C and I'll be answering case 2 questions E. Furthermore, the tax attributes from TSG Sdn Bhd such as unabsorbed tax losses or unabsorbed tax incentive can be claimed by Damchi Sdn Bhd, which can carry forward the accumulated tax losses and unutilized capital allowance of TSG Sdn Bhd and can be set off against future business income of Damchi Sdn Bhd. As a result, the accumulated tax losses and unutilized capital allowance will reduce the chargeable income of Damchi Sdn Bhd, resulting in lower tax payable. Transfer of shares are capital in nature, hence not taxable unless it is RPC shares which will subject to RPGT. Even though Damchi Sdn Bhd could acquire KY Sdn Bhd, the company had a large amount of unabsorbed losses due to KY Sdn Bhd being dormant. With effect from the 2006 year assessment, the accumulated tax losses and unabsorbed capital allowance of KY Sdn Bhd, a dormant company, shall be disregarded in the event that more than 50% of the shareholding in KY Sdn Bhd changes. As a result, Damchi Sdn Bhd should acquire TSG Sdn Bhd rather than KY Sdn Bhd in order to become more profitable.